Hey guys, so the Bank of England have just increased interest rates in the UK by 0.5% from 1.75 to 2.25%. So for today's update, I want you to share the background on this. I've gone and read the Monetary Policy Committee minutes of meetings, and I want to just break down all the jargon, just break down what exactly they thought about when they came to their decision, and also just share their findings from an economic perspective and what we can expect to happen down the line. If you've got a mortgage and that sort of stuff, I'll also be sharing what you should expect to be happening and what you should be doing right now in order to prepare yourself for the future rises that are expected. So the background is we've obviously had rises going on for quite some time, and there was an expectation that the Bank of England would actually increase rates by 0.5%. However, the Fed in America, Federal Reserve, increased rates yesterday by 0.75%. There was a large expectation, actually, that the Bank of England would actually follow that and increase interest rates by 0.75% because of how inflation has been proceeding. But there are certain things that have happened since the last update that I made here in August that have led to the Bank of England sticking with 0.5%. And that decision, by the way, was not a unanimous one. So to give you some perspective, in the last meeting, 8 people voted, 8 people of 9 in that Monetary Policy Committee, 8 people voted for a 0.5% increase. That's in August. But now in September, very interesting, only 5 people voted for a 0.5% increase. 3 of them voted for a 0.75% increase, and 1 of them voted for a 0.25% increase. And that gives us some clues, in a way, of where we expect interest rates to be going in the future. But I want to just share some highlights that came out from actually reading those minutes of meetings. So the first thing to highlight is that the long-term goal of the Bank of England is to try to get target inflation down to 2%. Okay, they've been saying this for a while. This is their long-term goal, but we're very far away from that right now. So according to the latest, the research, the things that have just come out, the things they announced, 12-month CPI, which is the Consumer Price Index, fell from 10.1% to 9.9% in July. So you think, wow, that's good news, right? However, they're expecting inflation, reading this from my notes that I made here, they're expecting inflation in October to hit around 11% or just under 11%, okay? And this is given some really big things that have happened since my last update, which are that the government made some pretty big announcements. One is the energy price guarantee. This is one of the biggest things that came out and in a way helped to remove a lot of the uncertainty that we had when it came to inflation, to headline inflation that was expected to be a lot more when it came to January next year or Q1 of 2023. So that intervention from the government where, £2,500 per household was introduced from a price cap perspective for energy really helped to bring inflation down to the expectations that they are forecasting right now of around 11% around October. But bear in mind, the government intervention is only for 2 years, okay? So whilst it's great for us, it's great for families, it's great for anyone really, it's great for people who pay bills, whilst that's great, that intervention is only for 2 years. And what's interesting about that is that although that intervention helped inflation, they're actually saying, well, actually, it's going to help to contribute to inflation in a way, because although people are not going to be spending as much as they expected from an energy perspective, it means that money is going to be going somewhere else from a demand perspective. The second thing that was key from the last meeting was an announcement of growth plans by the UK. So tomorrow, there's meant to be some news, that the Chancellor is meant to be announcing growth plans for the UK, which will then impact on the future economic direction of the country, which obviously tied to that would then mean the forecast the Bank of England will have for interest rates in the future might then change in some way, okay? But notice the votes I mentioned earlier. 5 people voted 0.5%, 3 people voted 0.75%, and those 3 people, by the way, and they're thinking for that, and this is worth hanging on for their thinking, really is that in the medium term, they're seeing that in the medium term, they believe that the expectations of consumers, expectations of firms and things, the medium-term expectations from an inflation perspective are a lot higher than they thought. Yeah, so in their view, it's for those three people who voted 0.75%, it's much better to actually be much more forceful from an interest rate rise perspective right now, feel the pain now, and therefore not feel as much pain as we go into the future. But obviously, those three people got outvoted, and obviously you can go and read the notes and the minutes yourself and actually read the details. But I think it was very interesting that three people who had voted 0.5% only last month decided to vote 0.75 a month later. Yeah, given their knowledge of the government intervention and all these various things. So for me personally, that's a clue of what we should expect for the future. Now, looking at economic, let's talk about the economy and what sort of things they brought up. So looking at housing, this is a really interesting one. So the minutes in the notes said that although a number of indicators of housing activity had weakened in the 3 months to August, the Bank of England are reporting that house prices remained strong. Wow, that says quite a lot, right? So even though inflation keeps rising and you expect that the interest rate rises will actually gradually start to, weaken demand, house prices remained strong. In fact, they went as far as saying that the Office for National Statistics UK House Price Index picked up in July. The index picked up in July after a fall in the 3 months to June 2022. So there you go from a housing perspective. So it would appear that house prices are, really, keeping the momentum and really staying steady. Okay. Now, I've talked about inflation, I've talked about house prices. Let's talk about mortgages, okay? So most people in the UK have fixed rate mortgages. About 75% of borrowers have a fixed rate mortgage. So this increase of 0.5% will not affect you right now. Okay, that's the key thing to note. However, a lot of those people are in the next 2 years will be coming out of those fixed rate deals and will be hit very strongly by quite a big change in their monthly mortgages. So those people on fixed rate deals don't have to worry now. However, there are about 2 million people right now who have variable mortgages in the UK. Those 2 million people, for every £100,000 you have in a mortgage, you see around £25 per month increase in your mortgage given this announcement. So that's worth mentioning. Okay. So my suggestion on the back of that is that you go ahead and get yourself a fixed rate deal. I know I've said this in previous updates, but given where we are and given where I believe we're going, given where all the data, all the indications, even looking outside the UK, looking at the Fed and looking at Europe, what everybody else is doing, what they're all doing is aggressively increasing interest rates by 75 basis points, 0.75%. Okay, so I personally see a future where, a near future, by that I mean in the next few months, where the UK actually follow and do a similar thing. But again, that will all depend, like I mentioned, on what the government announces tomorrow from a growth plan perspective. So things might change, but it's safe enough to assume that interest rates are carrying rising much more aggressively. So go and get yourself a 5-year fixed rate deal ideally, because they're still doing really good deals on those, offering discounts on those, even now. And I should mention, by the way, the rates you should expect to be paying, expect to add another 2% on top of what the base rate is. So now the base rate is about 2.25%. These mortgage companies need to have a margin. So roughly about 4.25% is what you might be expecting to pay thereabouts. So covered mortgages. Oh, I should mention about savings, okay? So obviously interest rates are rising. People who have money in their accounts, this should spell good news typically, or naturally you should expect that the savings accounts will start to pay more. But to be honest, most of the banks out there will likely not really pass on this increase from the Bank of England. Why? Because they'd already priced it in. Okay, and so you might not see a material increase. So the action point there for savings is really they should focus on trying to shift to the banks that might actually offer an increase. So a switch might be what you might need to do. Okay, but note that and I forgot to make this point in my last update, that although savings rates might be increasing a little bit, note that with inflation so high, your real wealth is actually depleting in value, really, because you're not really earning that much. So from a real perspective, factoring in nominal inflation, though the savings is helping a little bit, it's not really your money's not actually growing from a real perspective. Another point mentioned from an economy perspective was GDP. So the minutes of meetings said that they expected, this is interesting, they expected a fall of 0.1% in Q3, followed by a second quarterly decline. Okay, again, very interesting. And the points they made here was that business investment, from a business perspective, so business operators, their intentions are that they are easing their activity owing to uncertainties about demand from poor economic outlook, higher prices, and that sort of stuff. So again, a lot of these intentions and expectations for the future, which are driving inflation, by the way, might change depending on what the government announces from the growth plan perspective. Now, I should mention that it's definitely worth, one thing I found really interesting reading was one of the members of the Monetary Policy Committee, a lady called Catherine Mann, Mann, wrote a really interesting, had an interesting speech that was published on the Bank of England's website. And I really enjoyed reading this because he gave some really interesting insight into why she voted for 0.75% increase, as well as why some of her other colleagues in that committee voted for 0.75% increase. If you don't mind, I'm going to just share real quickly. One thing they discovered based on their research is that, I mentioned earlier that the Bank of England have a goal of a 2% target for inflation. One thing they discovered was that from a medium-term perspective, households, firms, and commentators expect prices to carry on rising. That's very interesting. They expect, based on the data that they've got, the data has shown them that people expect prices to keep rising. However, the data has also shown them that, and this is, let me make sure I find the right section, has also shown them that they can, there's evidence that direct monetary policy intervention, i.e. playing around with increasing interest rates or decreasing interest rates, this is a key bit, has an effect on forming forward-looking expectations. So what they're really saying, I'm trying to break this down as basically as I can, what they're really saying here is that what they choose to give us, to present as the base rate for interest rates, has the power to change our expectations for the future. So psychologically, what they're really saying here is that if what she was saying in that report is that if they approached interest rates from the perspective of front loading the rates, i.e. literally bringing like rates from next year and bringing it into 2022 and charging much higher and presenting much higher rates up front, if they front load and almost force much higher rates into the present, then those higher rates will send a much bigger signal to us households and consumers and market operators, will change the future expectations that we have about prices for the future. I.e. practically will mean that fewer people go out there trying to buy houses, going shopping, doing all the things that they might do ordinarily, because they, the impact that those higher rates will have will essentially bring demand down in the medium term, which would then mean that there'll be a much less painful intervention required from an interest rates perspective further down the line. Okay, I thought that was actually a really interesting perspective, which is why she, along those lines, voted for 0.75%, and some of her colleagues did, whilst 5 people voted for 0.5% and outvoted them. So all that to say, to summarize this video, all that to say that the rates have gone up, and the two biggest things that have kept rates at 0.5% as an increase rather than 0.75 and much higher are the government intervention from an energy price guarantee perspective for the UK people. So, we're not going to feel as much pain, even though, the price cap is still stupidly expensive and, it's still a lot more than most people were paying before. We're supposedly being told this is meant to be a good thing, and it is a good thing, but you get what I'm saying, like it's still really expensive. That intervention has helped inflation massively. The second intervention is this growth plan that's expected from the government. So those two key things have kept interest rates at a 0.5% increase. what are the next steps? Next steps are that the Bank of England will now go away and crunch, look at all this information that's coming out from the growth plan, and will then update their forecasts for November. Yeah, so we'll be expecting another update, and I'll keep you guys posted. But I should mention, I'm just zoom out for a second and just say, apart from actually just trying to break down, the numbers, or break down, the stuff I'd researched and stuff, I'm breaking it down. I just want to just, speak to you as just Ken, as a normal, as just an individual, and just say that I know a lot of people are struggling with what's going on. Like, these things are just going up, and every day we're just being told, yep, you're paying another £25 per month. Yep, you're paying another this, and it just feels like a massive attack from all angles. I just want to say, stay encouraged in these times. Do everything you can to stay, to look after your finances, to look after yourself, look after your mental health. Obviously, do the basic things that we teach on this channel around budgeting and try your best to kind of look after your money. But above that, let's be forward-looking. Like I mentioned earlier, look at changing your mortgage property if you can. Oh, and I should mention, by the way, you can do this 6 months in advance for a lot of banks. So if you go to your existing mortgage provider, a lot of them allow you to do it 6 months ahead. So check to see when your deal expires and try and get that done definitely before the next update from an interest rates perspective. But above all that, thank you for watching this update. And if you've got any questions related to this or anything else that I've mentioned, please feel free even to drop me a comment below. All right, guys, thank you, and see you on the next update.